Now that we understand how to solve this problem with both a formula and the intuition that you've already learned, let's look at a real-life example like credit cards. The average annual percentage rate for a credit card is around 18%. Now, in reality, credit cards actually often charge daily interest. It's a little complicated for us to go through. So for our example, let's assume that our 18% APR credit card charged monthly interest. What would the EAR of our 18% APR credit card be? We know our APR is 18%. So let's apply our EAR formula to determine what the EAR would be. So that's going to be 1 plus our APR over M, the number of periods in a year, and we're looking at months, to the power of M minus 1. That would be 1 plus 18% divided by 12 to the 12th power minus 1. And the answer to that equation is going to be 0.1956 or 19.56%. So when a credit card or another financial lender suggests that they have an APR of 18%, but compounded monthly, you can now understand that the actual rate you'll be paying would be 19.56%. Let's look at one more example. When you're driving around a new neighborhood, one way you can tell the neighborhood might not be one with a lot of economic strength is to look at what kind of retailers are in the neighborhood. If you see bars on the windows, or you see a lot of payday lenders, that might be a sign this is an area that isn't one of the wealthiest areas in this urban core. Payday lenders are a really interesting model. They will charge a small fee or interest rate in order to advance your payday. So let's say you were to get a $200 loan for your paycheck that was supposed to come in a couple weeks. Oh, when you go talk to the payday lender, they might say something like, $200, $20 fee, no big deal. Well, what actually is the APR and EAR on this $20 fee? Well, if we had $20 on 200, that would be 10%. Now this 10% is over a 2-week period. Well, we know there are 52 weeks in a year. So first, what would our APR be? Well, our APR is pretty straightforward. Our APR, we're going to take the 10%, our periodic rate, and multiply it by the number of periods in a year. In this case, since these are 2-week periods, and there are 52 weeks in a year, there would be 26 2-week periods in a year. So the APR for this $20, no big deal on your $200 loan, would be an astounding 260% APR. But now, let's take a look at what the EAR would be. The EAR would be 1 plus our APR of 260% divided by the number of 2-week periods in a year, or 26, to the 26th power minus 1. Now, if we go ahead and do this math on Excel or a calculator, the answer you will find is 1,092%. Though unfortunately, the people who go to payday lenders can be charged as much as 1,092%. Now, currently, there are a number of states exceeding 20, with various legislation limiting what payday lenders can charge, although many of them get around it with fees and other ways to charge their customers. Now that you have the tools to make informed financial decisions, you can decide what financial choice is best for you, whether it be a payday lender, a credit card, a bank, or another financial institution. Make the decision that is best for you, the consumer.